nature of the economy that they're supporting has undergone quite a big shift recently. And if you want to think of it's sometimes useful to sort of think of historical parallels. I want to think in narrative terms. You know, when we talk about the vision of the future, we have to construct some sort of narrative around that. So if you imagine, I mean, because I'm English, I'll pick a domestic example, but if you imagine what we still refer to as the Glorious Revolution of 1688, at that time, the currency of England was in a terrible state. The coins were they were what was called clipped. So the silver coinage was in a terrible state. People were stealing little bits off the coins and filing them down to make new coins. And when the government tried to fix the problem by bringing nice shiny new coins into the market, those coins immediately vanished. It's called Gresham's Law, after Sir Thomas Gresham, who's the official hero of the Digital Money Forum in London, because he was Britain's first economic terrorist who disrupted the build-up to the Spanish Armada by cornering bills of exchange in the Netherlands. And it's named after it, Gresham's Law. Good money drives out bad at fixed exchange rates. So of course, when good money came along, people immediately took it out of the marketplace and hoarded it. And it was only the bad money that stayed in the marketplace, which meant that the transaction costs associated with any kind of economic transaction went sky high. Because even for the smallest transactions, you know, I'm going to buy your course, or whatever it was people sold to each other in 1688, to get together the coin and to assay it, to check it, and to weigh it, was a big production. And so at the time, if you'd have been talking to people about, well, what's going to happen? You know, they would have thought entirely in terms of silver coin. Well, you know, something's going to happen to make the silver coins better, right? So we'll make that a better quality silver, or we'll come up with some even more gruesome penalties for clipping the coins and counterfeits. I mean, the penalties were quite gruesome. I mean, they started off at the relatively mild, I mean, the kind of milksop liberal end of the spectrum, which is having your nose cut off and stuff like that. It got pretty significantly worse. It didn't. Well, it was asymptotic. I mean, it didn't really help. I mean, the counterfeiting still, particularly criminal classes in England at the time. So, but if I'd have been challenging you, you know, what's your narrative of the future? Your narrative of the future would have been, well, you know, we're going to figure out some way to make better silver coins. We're going to figure out some way of putting them in a strong box. We're going to figure out some way of transporting silver coins around more effectively than we can do now. Someone's going to make a machine that you can drop silver coins into, and it will somehow assay them. You see what I mean? Like, that would have been the narrative about it. Of course, what actually happened from in less than a generation, from 1688 until when Isaac Newton died in 1727, he was appointed as the master of the mint. He was responsible for the Great Recoinage of 1696. What actually happened in less than a generation, we had a central bank, which was founded in 1694, and circulating paper currency, which no one could conceivably have imagined 6 years before. Because the central bank wasn't created to make circulating paper currency. The central bank was created with the entirely laudable goal of financing a war against France. The fact that the notes began to circulate for the convenience of merchants, that was a happy side effect. That wasn't the point. But the point is, no one could have imagined that. And then we had the recoinage when all the silver was called in, and the price of silver was fixed at mint properly. And so, because what had been happening before was when you minted new coins, they were immediately taken out of the country, and they were sold melting down in what's now Belgium and the Netherlands, because the mint price of the silver was wrong, basically. It's like, because governments don't get these things right. You live in a country where it costs more than 2 cents to make a penny. I mean, you know, and you're telling me that money works okay, what's the big... I hope you're listening to this. It costs you more than 2 cents to make a penny. If that was my business, I'd be out of that business. I don't think like the federal government. 7.7 cents to make a nickel? You know, what is... You know... Anyway, the point is, you know, you had a central bank. Isaac Newton put the country onto a gold standard, which was an entirely new thing. And then you had, in one generation, a completely different monetary system, which nobody had expected. And the reason for it wasn't because of wars with France, that's part of it. The reason was because the economy had changed. We were living through the early stages of the Industrial Revolution because people didn't know that. I mean, we know now that that was the Industrial Revolution, but people at the time didn't know that. They just knew that people weren't working on farms anymore, they were working in towns, and there were no coins to pay them. And so people had to come up with all sorts of crazy schemes for substituting, because there wasn't any money, so you had to come up with some stupid things like that. So there are what economists call weak signals for change. Things that when you look back on them, you can see that everything was going to change. But at the time, you couldn't see it, right? And so my point is, I think we have those weak signals for change now. We have the same problem they had in 1688. We're using the money from a previous economic era to try and support the commerce of a new era, and we're doing it very inefficient. Just like those guys who are trying to fix silver coins. We stick band-aids on credit cards and put them on the web, and it sort of works, so, well, that's okay. But it isn't okay, We're moving to a different kind of economy, and we need a different kind of money to support it. So my point is, when you talk about sort of real innovation, when you're trying to construct a narrative about the future of money, that narrative can't be, we're going to come up with a slightly better way of doing coupon offers in Google Wallet. That's not a vision for the future. So what we've done is, we've picked people who are working in innovative. We've picked people who are I am making fun of it, you know what I mean? It's like we're all it's not like I'm some genius, I know what's going to come. I don't know what's going to come, but I can see that it's not what we had isn't sustainable. And you look at what happens in some other countries, and you see a different approach. You were talking about East Asia, where if you lived in somewhere like Singapore, the idea that you could log onto a bank account just using a password would be hilarious. Like, that would be like you're not taking security seriously, which you're not, by the way. But I mean, it's not, you give people your passwords to do screen scraping on accounts and stuff like that. Instead of having proper APIs. So what we've done is we've taken guys that are working in innovative companies in the payment space. We're going to ask them to, well, first of all, they're going to explain to you what their companies do, so you can see where they're coming from, and they're going to talk a little bit about what they see. And then I'm going to press them a little harder, because we've been downstairs talking about, what we might see in 10 years' time, not a generation's time, but based on what we've got. So basically that's our plan, and then we're going to get you to ask them some really tough questions about how we're going to move this space forward. So, and remember, we want to try and have a narrative vision of the future. We want to end up telling a story about the future in payments that we can all sort of understand and buy into, right? And so that has to be if we have our innovative vision of the future, we're going to make this change in field 7 of the EMV authorization. That's not a narrative, we need a story about this stuff. Okay, so let's start with Jay. Would you like to go first? Because I think, and you might need to explain for some of the foreign visitors what a check is in order to get the thing off the ground.
My name is Jay Bhattacharya. Thank you for having me. And I'm the CEO of a company called Zipmark. I'm also an ex-banker and a credit card executive. And what Zipmark does is we enable an easy way for merchants and individuals to send and receive money from their checking accounts using 100% digital checks that are risk managed, they don't bounce, and they are created and settled in real time, as close to real time as we possibly can. So right now, we have a real-time check payment mobile application, online application, and even for merchants that do paper bills and invoices, we have a QR code trigger for those payments. And for payers, it's an easy way to make a payment when you don't need access to a credit card. And for merchants, we significantly reduce the fees for receiving money. And we settle with the merchants immediately as opposed to on a rolling basis because we're managing the risk in real time. The vision for Zipmark came about really from my experience in the credit card space. I started in credit cards at a time when things were moving online. There wasn't online acquisition of customers for credit cards. The idea then at that time was go to our website and give us your home address, and we'll send you an application. And because I started from at a time when that was the requirement, and at a time when the thought around the internet and the nascent thoughts around mobile was that these were going to be edgy channels that are going to be high risk and low reward and all that. And because I was able to kind of see how that didn't really happen, and how it became much more than just a channel. The idea for Zipmark was really around taking payments and banking really to what they actually enable, and that's really about enabling commerce. Our client is the merchant or the biller, whoever is actually providing the service to the person that's paying for it. And we feel like when we look at banks and card issuers and other companies, that thought has been lost when they layer on fees and delays and other administrative requirements on the merchants. And so our core principles are around very, very simple, manageable pricing that doesn't have 55 different categories per transaction. Fast settlement, because you make the sale, you want the money, and really everybody with a checking account is eligible to make a Zipmark transaction. So we're not signing anyone up for another account. You're registering your existing checking account today, so the checking account that a payer gets paid from their employer is the one that they use to make a Zipmark payment for their rent, for their utilities, or whatever they're paying for. And the operating account that the business is using to make payroll is the one that they're getting paid into by their customers. So it makes cash management a lot easier and a lot more transparent. And that's the other principle of our company, is that we eliminate the float. A lot of the ways that banks and other companies manage risk and processing is to hold funds, and we actually push funds out before it's settled. So we actually take risks and guarantee transactions, and our goal is to become really, really good at just being able to do that and get money to the people that have billed for that money right away.
I'm presuming your margin depends a bit on that risk management, right?
Absolutely, absolutely. So the first development cycle for the company was built around this first time ever real-time authorization engine for checking transactions that didn't rely on taking the money out of the banking system and putting it into a prepaid account or anything like that. We wanted the money to stay in the checking accounts, and then when you have the intent to transact, your intent is to pay the party that you're paying. You're not trying to fund PayPal's business model or some other company's business model, right? So our true intent and our true the goal of the platform is to get money from my account to whoever I'm trying to pay right away.
And the banks give you some sort of API for doing this?
Oh yeah, yes. The APIs weren't really available the way that we needed them. We had to spend a lot of time with folks trying to get them up to snuff. Right now, these are the types of products that are used in things like telecheck, where you call with a check, or when you use a check at a retail outlet today, and they have to make a phone call to somebody to verify that check. So those are the kinds of services. Those are the APIs that were available when we started development.
I see you've improved them.
Yeah, well,
Excellent, excellent. So, Bill.
Hi. My name is Bill Clerico. I'm the co-founder and CEO of WePay. What WePay does is we dramatically simplify e-commerce so that anyone can accept online payments with less than a 2-minute setup process. And so this enables e-commerce for the long tail of merchants that have never accepted online payments before. And it's people like your gardener, your maid, your personal trainer, your handyman, your dog walker, and also things, social causes. For example, the Occupy Wall Street movements all used WePay to accept donations online. So we found that by stripping all the friction out of that setup process, you enable all kinds of new use cases to participate in e-commerce. So we stand on 3 pillars. The first is a really quick setup process, so that again anyone can get up and running in 2 minutes or less. 2 is ease of use, so we have a really friendly UI, great customer service, and probably most importantly a risk management process that really doesn't introduce friction into the merchant's experience. So we don't freeze our customers' accounts. We have really simple automated ways for them to prove to us that they're a safe merchant. They are who they say they are, without 15 pages of merchant underwriting applications and things like that.
Well, that like what? Can you give us an example?
Sure. So I think if you are a service provider and you want to use a service like PayPal to accept online payments, and you hit certain thresholds, the risk management processes at PayPal will basically freeze your account and mandate that you provide all this proof that you are a maid in Palo Alto who cleans houses. and that you are servicing real customers. And that's really hard for these service providers to do. If you're a merchant on eBay, you can provide tracking numbers and shipping manifests to show that you're shipping iPods, and PayPal will unfreeze your account. But if you're a service provider, there's no real proof of purchase. So we built our risk management process around reputation. And so we'll look at the Yelp reputation of these merchants, the LinkedIn reputation, Facebook connections, all this other data that's available now that doesn't require us asking the merchant for tons of paperwork. And so we can maintain that simple 2-minute setup process without freezing their accounts and still controlling the risk associated with these merchants, because they are typically higher risk merchants than a card-present merchant or a typical retail merchant. And so I think lastly, too, an important distinction for us is that we give these merchants this sort of complete commerce experience. So they don't have to sign up for a merchant account and bolt it together with a storefront and build a website and sort of fit all these pieces together. A lot of these guys are, relatively small, first time, they're sole proprietors, they're not an IT guy. So we give them this kind of out-of-the-box commerce experience where they can send invoices that look professional, they can have a storefront that looks professional, payments is built in, again, really simple setup process and good customer service.
Excellent. That's a very good description. Actually, I'll ask you about the future in a moment. Yeah. Mike, sorry.
Hey guys, I'm Mike Bettler I'm the founder and CEO of Card.io, and we're a mobile payments company. So we build the easiest way to make a purchase on your phone. There's no typing, you don't need a dongle or a square, you just hold your credit card up to the phone camera and we scan in a number. And we provide a couple services. One is a direct-to-consumer application. You can download it to your phone, and you can start accepting cards. You don't need any hardware. We also provide an SDK that's used by about 200 mobile apps. With this SDK, you can add this Card.io scanning feature to your application. It's used by folks like Level Up, Uber, and PayPal to accept payments. And the benefit is it's just easier for users, and apps sell more widgets. So that's what we do. We build interesting card scanning technology and make frictionless payment process both for users and for developers.
And this saves people time because they don't have to type in the card number, basically. That's
It saves people
it's a
time.
convenience.
Yeah, it's mental overhead. It turns out that people don't really want to save time. They're just kind of lazy. And so even if it's only a couple seconds faster, people will do it just because it's less stuff to type and think about.
Perfect. Right. Okay. So now we understand what you do. Now let's turn our thoughts to the future. So let's push you guys a little bit. So what's going to be different? Let's say 10 years from now, and I'm curious about how what you're doing is going to sort of contribute to it. So let's go back and start with Jay again. I was in a meeting in the UK. There's a big fuss in the UK because the Payments Council in the UK announced the end of check clearing. Well, they were going to look at the end of check clearing in 10 years' time. And people went berserk, even though checks are an absolutely absurd way of paying for things, but people are very conservative. So I'm pretty sure that in 10 years' time, people are still going to be sending these checks to each other, right?
Well, ideally we'd like to see the end of the paper artifact known as the check. What we do and what we keyed in on about the U.S. checking system that was different than other ways of moving money is the fact that it's actually designed around commerce. A lot of the other mechanisms, cards, ACH, and others are built around how banks can effectively leverage the fact that they sit on these pipes and sit on these networks to actually extract revenue from the system, or and in a lot of cases provide some incremental value. But we wanted to really laser focus in on the parties that we're trying to transact. So when you ask about the future, I think it's really about making sure that the transacting parties are able to do what they intend to do, because that's really what generates the value. I know that there's a lot of discussion, we get into a lot of discussions around things like reward programs and loyalty and things like that. We're trying to create a very fast, very, very low cost for the merchant mechanism to get paid. It doesn't leave a lot of room for, high value rewards programs and things like that when you look at it on face. But if you really think about it, better payments, faster payments, cheaper payments are going to enable more commerce and more business. And I think that that's one of the things that gets lost when you talk about friction in the space. we should all be working hard to remove any friction from any kind of payment mechanism. And I think that it's inherent in payments because it's this friction that slows down the flow, and that's really where third parties can come in and create sort of secondary value pools.
There's another factor that I think is there which will shape it, which is that because of the US sort of pre-Civil War regulatory environment around checks, you're still allowed to send people to jail for writing bad checks. Which we're not allowed. If you use your credit card fraudulently,
right?
We don't have these kind of sanctions.
That's right. No, we didn't.
So
we did pick checks because it's a felony to pass a bad check. We were hopeful to use felons in the process of building them. But
the point I'm making is, there are other parts of the economy.
Yes.
Where when you're trying to think 10 years downstream, it's about science and innovation and what kind of cool new stuff people come up with.
Yeah.
We're not in that world because we're in a world where innovation is constrained by, in many ways, a suboptimal regulatory environment.
Yes, absolutely. And and that's by and large, because you're sitting on banks trying to protect their share, right? And I think that if you look at, we look at Zipmark, the principles of our company designed to protect the two parties that are in the transaction. We don't really try to protect anyone else. We don't try to protect, a bank or anyone else. We follow the rules around regulations. We follow, our requirements around, knowing your customer and anti-money laundering and things like that. But, we're not creating, that incremental sort of tier. And therefore creating that extra link on the transaction.
Perfect. So let's make the same challenge. So, Bill, if you, I know, future to guys like you means kind of next quarter or like next funding round. So I'm not unrealistic about this. But you must spend some time thinking about what's really going to change a few years downstream.
Sure.
And frankly, this thing about everybody becoming a merchant. You'll hate me for saying it, but the square effect.
Sure.
That's real, right? That must mean something different downstream, and everyone can take electronic payments, right?
Sure. Yeah, I think it's mostly around most of the long-term vision and long-term value we see in this space is really around identity. Not only of just the merchants, identifying who those merchants are, identifying their reputation so that the risk can be underwritten, but also capturing identity information about the payers. And so we made a very conscious choice not to go kind of the card reader route because we feel like there's real value in owning the payer and being able to know who that payer is, have that payer pay using your system, have data about that payer. And so we really push our merchants to do e-commerce, to send an invoice to a customer and have that invoice sign up so that we can collect data about both the merchant and the payer. At this point, we have over 1 million people in our database and a bunch of great additional data about those people. We can examine their connections to new merchants, their interactions with those new merchants, and use that to underwrite risk. And so I think our kind of grand vision here is we're driving towards something, I think you coined it 5 minutes ago, which I think was a great way of putting it, was the riskless transaction. And I think when a company or a bank or a financial network can truly know both sides of the transaction, you can basically drive almost all of the risk out of that system. And so the question is, how do you do that? The good news is today, and there's this great quote from Eric Schmidt from Google, we as a human race create more data every 2 days than we did from the dawn until the year 2003. And so think about just like the amount of tweets coming out of this room alone. It's just, it's a tremendous amount of data being created every second by everyone sitting in this room. Your locations, your cell phone IDs, your tweets, your pictures. And so we look to all of that data and all of that information to be able to better understand who our merchants are and who our payers are. And so by amassing all of that data, looking for interesting patterns in that data that we can infer risk or safety from, we can drive risk out of the financial system and at the same time reduce friction for our users. So instead of asking you for 15 pages of documentation, we can go analyze your Facebook profile, your LinkedIn profile, your Yelp profile, various other data sources we look at as well, and use those to make credit underwriting decisions for our merchants. And so right now we do that in merchant processing, but I think if you really think 10 years in advance, why couldn't we do that for mortgages and loans and all kinds of other really interesting financial products? And so, I think there really is big data is kind of a buzzword, but in payments, it's traditionally referred to more around loyalty and advertising targeting and things like that. But we think there's real value in risk management and the data associated with that, and looking at all these new kind of crazy data sources that really do provide good signal into our risk engine. So we're a user experience company, but it's powered by real technology and risk management that allows us to underwrite these merchants with just a couple of clicks.
Do you think the general public are sort of comfortable with the use of their payment data for these? Or it's just like they don't really understand what's going on? So.
Yeah, I think there's sort of two parts to that equation. I think a lot of that data is just public, as is. And so, it's people share all the time. They share their locations, they share their statuses, they share pictures, they share how many friends they have on Facebook. A lot of data is very publicly available, and it is very valuable from a risk perspective. So I think that helps a lot. I think also, though, what we found with our merchants is if you can create a value proposition to them that we're going to make it so simple for you to get up and running, we're going to allow you to accept payments online, and you're going to have to give us 5 pieces of information, and that's it. One of which is your Facebook login and credentials, and authorize us to pull data from that account. We found that a fair number of merchants do opt into doing that. And it also provides them with additional benefits too. Like a lot of our merchants will use Facebook as a distribution platform to attract new customers and to share various aspects. With a lot of the Occupy movements that use their service, they give us access to Twitter information that we can use to underwrite risk because they were using that to drive donations and awareness. So I think people will become increasingly more comfortable. And if you kind of look, a good way to predict 10 years forward is to look 10 years back. And 10 years ago, we didn't even put pictures of ourselves online, and now we're putting pictures of our newborn kids and sharing them with the internet. And so I think people are becoming more and more comfortable with sharing data if there's real value provided them in return.
Yeah, I think that's absolutely the key. This is information that's being shared and used, and in most cases, with at least the merchants that we're talking to, they know more about those customers, than their banks do, right? And to your point about pictures, the story that I use, I was in the credit card industry when they tried to put the pictures on the credit cards, and people went crazy, right? It's one tiny, half a postage stamp size picture of the person whose card it actually is. And now there's, 1,000 ways. I could probably get 1,000 pictures of, the 4 of us here on the panel with one simple Google search. And, I think to that point around, the information being available, not only is it available, it's what the merchants are using to deepen the relationships with the customers. And I think that, when you key in on this next generation of financial services, it has to be, really built around that entity in the chain that's actually trying to build a deeper, better relationship with the user. And I think that, like Bill was saying, if you build a platform that owns both sides of the transaction, that's when you can drive the most value. And I think that the legacy players in the payment space have made it their business to not be like that, right? And to actually just own one side of the transaction.
Mike, you, I think when we were talking before, we mentioned which Bill you mentioned as well actually, but this thing about the intersection of the social graph and mobile. I'm not smart enough to know where that's going to go, but I can certainly have the sense that there's something happening there, isn't there? There is some dynamism in that interface, which is going to deliver some unexpected consequences.
So the aspect that we see is from the mobile side, and I think certainly what Bill's saying is absolutely true. So you have the ability to really tie this person's identity to a mobile device and learn all this really interesting information about them, which has this really transformative effect when you start to look at risk. What we see also on mobile is actually a bigger shift, which is it's not just about knowing who that person is, it's about every aspect of usability on this device. So pre-iPhone, there really wasn't much commerce happening other than on deck. Now you see this huge proliferation of devices and methods of payment, and overall it's really broken. But overall what you see is this really big sea change in how people are thinking about transactions on the phone. And so from our perspective, that has a couple implications. One is everything is moving to software. So if you think about recent payments efforts that have either failed or stalled, you start to look at things like NFC that require dependencies on both the handset and at the merchant. You need to have extra hardware. More importantly, you need consumer behavior change, which is really, really hard to educate or to teach or to actually have people use something other than cash or credit. And so the interesting transformative effect that we see 10 years out is that the payment relationship in mobile is going to end up being owned by the platform. Apple, Google, PayPal, people that already have millions and millions of credit cards. It's not going to be Visa. It's not going to be Citibank.